Tumbled-PhillipCapital Weekly Market Watch. I'm Lin Sin from Phillip Securities Research. Today, we will be looking into the risks and impacts on the Southeast Asia's third biggest economy following a free fall in petroleum prices. Economic growth moderated in third quarter of 2014 as export growth cooled considerably. As you can see from here, GDP moderated, as well as from current account also moderated, and the trade balance as well as the exports and imports. Notwithstanding a slower GDP growth, we see concerns over a chain of events sparked by the plummeting oil prices as well as a decline in palm oil price have weakened the currency of Southeast Asia's third biggest economy. Concerns have been raised as to how fiscal deficit targets will be met should government revenue or GDP shrink. Doubts are growing over a 3% target for next year when oil prices plunged more than 40%, while its budget had been based on $100 USD per barrel. The prospect of twin deficits is another worry given the pronounced narrowing in Malaysia's trade surplus. The ringgit's sharp depreciation has compounded fears of costlier debt, higher import costs, and a potential economic crisis next year. But Malaysia is in a good position to withstand shocks, and that includes its debt as most are in local currency. As you can see from here, the blue one are domestic government debt, and the red one are external government debt. In addition, Malaysia's economy is broad-based to withstand lower oil prices and currency fluctuations, as it had in recent years diversified its economy and has been gradually becoming less reliant on oil. Petroleum revenue accounted for 31% of government revenue in 2013, from 36% in 2011 and 40% in 2009. Meanwhile, the mining sector, which includes oil and gas, accounts for about 8% of GDP, compared to the services sector, which contributed about 55%. As you can see from here, the red represents services as a percentage of GDP, while the green represents mining and quarrying as a percentage of GDP. In addition, the implementation of Goods and Services Tax, the GST, will further reduce its dependence from oil and gas revenue, while the removal of a 3-decade-old fuel subsidy regime in December 1st will cut spending. The government will implement a 6% GST, ensuring a broader tax base as part of its efforts to cut the fiscal deficit, in addition to the twice gasoline price hikes within the past 13 months, and the abolishment of the fuel subsidy regimes starting on this month. While Malaysia's fiscal positions are expected to strengthen, we expect inflation to trend higher due to the domestic cost factors. An increase in subsidized fuel prices will give a short-lived boost to inflation, and the implementation of Goods and Services Tax will continue to push up prices next year. However, moderate external price pressures and demand conditions will somewhat offset the impact of these cost factors on the underlying inflation. Notwithstanding higher consumer prices, Bank Negara may keep its policy rate unchanged next year, as the slide in commodities slows global economic growth. The central bank is likely to keep its benchmark rate on hold for the first half of 2015 as it assesses the impact of the consumption tax and removal of fuel subsidies on domestic demand and inflation. Although exports will benefit from the recovery in the advanced economies and from regional demand, the trend is likely to moderate, reflecting both the high base effect from 2013 as well as lower commodity prices. While private consumption may moderate, investment activity is projected to remain robust, supported by continued flow of ongoing and new projects by the private as well as the public sectors. Domestic demand will remain the key driver of growth. To sum up, while risks to growth have increased, the Malaysian economy is expected to remain on a steady growth path. On balance of the valuation metrics, as well as the downside risks, we maintain our neutral stance on the Malaysian equities. With that, I've come to the end of this presentation. Thank you for watching this week's Market Watch. I'm Lin Sin from Phillip Securities Research. Tune in for more Market Watch videos.